In the 1980s, one of the most well-known and most successful mutual funds was the Fidelity Magellan Fund, and it was managed by Peter Lynch, who ranks among the best investors ever. Just how good was Mr. Lynch? Well, from 1977 to 1990, the Magellan Fund's net asset value grew by an annual average of about 29%, almost double the growth rate of the S&P 500 at that time. It's hard for any investor to achieve a 29% gain in a single year, and averaging that over many years hardly ever happens. Fortunately, Mr. Lynch hasn't kept his investing thoughts to himself. He has written several well-regarded books that are considered classics by many: One Up on Wall Street, Beating the Street, and Learn to Earn. In this video, we are going to look at Peter Lynch's 6 lessons for investing successfully in the stock market.
So there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever kid was under the damn curve. I mean, yeah.
The past few months of stock market volatility have certainly made clear what Peter Lynch was saying in this quote. Those who don't expect volatility and can't handle it should look elsewhere to build wealth, although there are few places where you can build wealth over the long run as effectively as in stocks. Lynch added, "You've got to look in the mirror every day and say, what am I going to do if the market goes down 10%? What do I do if it goes down 20%? Am I going to sell? Am I going to get out of that?" You should consider reducing your stock holdings today. Emotions can be a real performance killer. If market drops get you selling out in a panic, or market surges have you greedily snapping up overvalued shares. The best investors will do the opposite. As Warren Buffett has said, it's best to be greedy when others are afraid and afraid when others are greedy.
I'm amazed that the average investor is out there in some industry. They're in the polyvinyl chloride industry, they're in insurance, they're in textiles, and they're going to see those industries turn. And they're not going to buy those stocks. They're going to go buy some stock from somebody in the National Guard, or they're going to do something on television in biogenetics. They have a big edge in me. I work awful hard, and they're months ahead of me. They can be in the healthcare industry. They're seeing new products. They should work on that they have in front of them.
It's also important to only invest in the stock of companies you understand, and some companies are far easier to understand than others. For example, that a certain company makes cancer-fighting drugs. You need to know what drugs the company has on the market and how well they're selling, what drugs are in its pipeline, and how close to market they are, noting that many drugs never clear clinical trials well enough to make it to market. You need to know about competitors' drugs on the market. Companies that make and sell soda or candies or shoes are simpler. Aim to be very familiar with the companies and industries in which you invest. Lynch has explained that, if you're prepared to invest in a company, then you ought to be able to explain why in simple language that a 5th grader could understand, and quickly enough so the 5th grader won't get bored.
Remember this one. It's futile to predict the economy, interest rates, and stock market. I mean, people keep trying to do this. I mean, this would be useful. I would love to know when we're going to have a recession. I'd love to know when interest rates are going to go up or down. I'd love to know when the stock market's going up. That would be helpful. I would like to get next year's Wall Street Journal. Unfortunately, you don't get it. People are so insistent. I'm that way too.
It's easy to let stock investing intimidate you. After all, there's some math involved. But much of the math isn't that complicated. The price-to-earnings ratio, for example, is a mere ratio of the stock's current price divided by its annual earnings per share. A dividend yield is simply the stock's annual dividend, which is often 4 quarters worth of payments, divided by its current stock price. As Lynch has noted, everyone has the brainpower to follow the stock market. If you made it through 5th grade math, you can do it. Many people buy stocks after only reading a little about them in an article, or, worse, after just hearing a little from a friend or acquaintance. For best results, you need to pore over a company's financial statements, checking to see how much cash and debt it has, how fat its profit margins are, whether its revenue and earnings are growing, and by how much, and other numbers like that. Ideally, collect lots of ideas of promising companies and study them to see which remain really promising to you. The person that turns over the most rocks wins the game. And that's always been my philosophy. He said, never invest in any company before you've done the homework on the company's earnings prospects, financial condition, competitive position, plans for expansion, and so forth.
The market went down. When I ran Magellan on 13 years, the market went down 9 times, and every time the market went down, Magellan went down. I was 9 for 9. And, because it's very important. This is another one of these numbers you ought to write down. If you put $1,000 in a stock, all you can lose is 1,000. I've done that several times. And but if you're right, you can make 5,000, 10,000, 20,000. So this business, you don't have to be right 1 out of 2 times. You can be right 1 out of 4. It's a long time. The times you're right, you know the company's doing well, you know they're doing a great job, and you add to it, or at least you don't sell it, which is a terrible tragedy.
Be patient, because most great wealth from the stock market is built over decades by rich and famous folks such as Buffett and Peter Lynch, and by ordinary people who got rich investing. As Peter Lynch has said, time is on your side when you own shares of superior companies.
People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people who can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read. I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates are going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics in the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know hotel occupancy stuff. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae or I own a housing stock. These are facts. They're economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick them on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? So I think that's, but you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means that's a euphemism for losing a lot of money rapidly. But we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime.
Lynch has said, investing in stocks is an art, not a science, and people who've been trained to rigidly quantify everything have a big disadvantage. That's important, because investing isn't solely about numbers and math. Consider, for example, the long-term capital management hedge fund was literally run by several Nobel Prize winners, and yet it imploded in 1998 and had to be bailed out with several $billion. Investing in individual stocks involves making educated estimates of how companies will perform, and when several smart and talented people study the same company, they may reasonably come up with different estimates and viewpoints. The car company Tesla is a good example, as it has ardent supporters and detractors. With this, I hope you guys able to understand what it takes to be a long-term value investor. With that, I will end the video.